This is a summary of my research about blank checks industry, which is in the finance sector. Blank check companies, which also known as special purpose acquisition companies or SPACs, are shell companies created for the specific purpose of raising capital through an initial public offering or IPO with the intention of acquiring an existing company, normally a private company. Unlike traditional IPOs, where a company goes public to raise capital for its own operations, SPACs or blank check companies are created with no specific business operations or assets other than the funds raised through the IPO. The purpose of a blank check company is to provide a vehicle for investors to pool their capital with the expectation that the management team of the SPAC will use the funds to acquire a promising business within a specified time frame, typically 2 years. Investors buy shares in the SPAC during the IPO with the understanding that their funds will be held in trust until a suitable acquisition target is identified. What are the advantages of investing in SPACs? First, access to early stage investments. Investing in SPACs can provide retail investors with the access to early stage investments in private companies that would typically be inaccessible until they go public through a traditional IPO. Second, potential for high returns. If a SPAC successfully identifies and acquires a promising target company, investors may stand to gain significant returns on their investment, especially if the target company experiences substantial growth post-acquisition. Third, risk mitigation. SPAC investors have the option to redeem their shares and receive their initial investment back if they do not approve of the proposed acquisition target. This feature provides a level of downside protection and risk mitigation. Experienced management teams. Many SPACs are sponsored by seasoned investors, business executives, or industry experts who have a track record of successful deal making. Investors may be attracted to SPACs led by a reputable management teams with a history of value creation. Like anything else, there are disadvantages in investing in SPACs as well. First, lack of transparency. Because SPACs do not have a specific business or operating history at the time of their IPO, there may be limited information available to investors about the SPAC's future prospects or the operational acquisition target. This lack of transparency can make it challenging for investors to evaluate the investment opportunity. Second, potential for dilution. SPACs often issue additional shares or warrants to finance the acquisition of the target company. This can lead to dilution for existing shareholders, reducing their ownership stake in the SPAC and potentially impacting the value of their investment. Third, uncertain timeline and outcome. There is no guarantee that a SPAC will successfully identify and acquire a suitable target company within the specified time frame. If an acquisition is completed, there is uncertainty regarding the future performance of the combined entity and the potential for shareholder value creation. And opportunity cost. Investing in a SPAC requires tying up capital for an extended period, typically until an acquisition is completed or the SPAC is liquidated if no acquisition is made. During this time, investors may miss out on other investment opportunities that offer more immediate returns or better risk-adjusted returns. Because I'm a value investor and I really need to see the consistent earning power of a company before I start investing my capital. That is why my conclusion is that these type of companies are not suitable based on my principles that I've outlined to myself. So because of that, I'm not gonna engage in investing in this kind of let's say opportunities, because it doesn't meet my one of my principles, which I need to see a previous track record of the management and also the earning and consistent earning and cash generating power of a company. So because of these reasons, I don't think this area is good area for value investors. I'm sure venture capitalists might be very interested in this type of opportunities in the market, and I'm sure you will find in the future or in the past as well, you might have seen some investors have made a lot of money and created a lot of value for their shareholders or their members by investing in this type of opportunities, which similarly is, in my view, is similar to venture capitalist investments. And however, as I said, this doesn't meet one of my principles requirements, and that is why I don't think this is the area that I'm gonna spend more time and deploy capital to this area. So that's why I'm gonna exclude this. This is gonna go to my no-go zone, and also it's gonna save a lot of my time in the future just ignoring this sector and going to the areas that meet my principles. If I want to share an example that I used this morning for checking this industry, I found out Armada Acquisition Corporation. This is a company in USA, blank check company in USA. I want to go through the business summary in the Interactive Brokers platform. Armada Acquisition Corporation is a blank check company. The company is formed for the purpose of effecting a merger, capital stock exchange, asset acquisition, stock purchase, reorganization, or similar business combination with one or more businesses. The company intends to focus on target businesses that provide technological services to the financial services industry, or fintech, that provide digital, online, or mobile payment solutions, processing and gateway services, point of sale technology, and the list goes on and on and on. The company is not engaged in any business operations as has not generated any revenue yet. Now let's look at the general information. So employees have got oddly 0, interesting, and incorporated, this is 2020 in USA, and the company is public since 2021. We said that 2 years period they've got typical time frame to invest, but they haven't invested yet. So investors, they've given them their money to the company. However, the company has not found any opportunity to invest. So I don't know exactly what's going on. I didn't go too much in detail, but to me, it's a no-go zone. I'm not a venture capitalist. I'm a value investor, so I'm not gonna delve into more details of these kind of companies anymore. As I said, there's no revenue, there's let alone no income, nothing. So how can I value this company? I just don't have the tools. So this is gonna go to no-go basket, and don't worry about it. Move on to the next one.